Welcome to Upticks. I'm Jake Falcon.
And I'm Corey Bittner. We're the founders of Falcon Wealth Advisors and your co-hosts for Upticks.
Today is our 45th episode, Understanding Mutual Funds.
We're talking about why plan, mutual funds, and questions worth asking.
All right, Corey, to kick off our financial planning portion of today's show, I wanted to talk about why do we even do financial plans for clients? Why are they a necessity to the way that we manage money?
Because without a plan, if you're just trying to invest, you're simply speculating. So the idea is the financial plan is sort of what gives us, not even a roadmap, but we have to have some type of goals in mind that the investments are designed to help achieve, as opposed to just investing for the sake of it.
Right, so it's almost kind of like planning a vacation but not knowing where you're going.
Yeah.
But I don't like to use the word roadmap for a financial plan
Right.
because it is dynamic and it changes in there. But the idea that you made a good point that if you just invest your money and you don't have a plan or a goal, you're really just speculating. For instance, neither of us are really big gamblers, but people that do go and gamble and play blackjack, they typically don't say, all right, I'm going to put in $100 and I need to make this grow to $200 in the next 5 hours.
They're just going to see what happens.
Right, they're going to see what happens. And people that invest that way, it's very risky. And it creates a lot of emotional volatility because, again, you're just riding the waves of the market, similar to gambling, right? There's a lot of emotional volatility deal with gambling. And so for us, for our clients, particularly for our new clients, before we give them any investment recommendations, we like to sit down with them, take a big step back, and say, hey, what is this money really designed to do?
Exactly.
All right, what do you want to do with this money? Do you want to retire and be a millionaire? Do you want to buy a new boat? Do you want to spoil your grandkids and pay for their college? Yep. I mean, what do you really want to accomplish? And then we start crunching some numbers and working our way into it. But I think a lot of people lose sight of that. It's a very important part of our process. The way that we price our practice, at least, the planning fee is already wrapped up in the asset management fee, so it's an all-encompassing cost. So our clients aren't paying two fees; they're basically paying a one charge for everything. But planning is a very, very important thing to do, and I would argue that the majority of my client meetings are spent talking about the plan, not talking about the investments.
Agreed. Yeah.
And didn't you have a new client come in the other day with? You said they just kind of pushed in some statements and said, "Okay, what should I do?" Maybe you can talk about how that conversation went a little bit.
Sure. I met with a new prospective client, couple actually, husband and wife, and they came in and kind of had expectations of what the meeting was going to be like, and in thinking that they said, here's all my statements, this is what I have here, this is what I have here, kind of just wanted to dive right into it. And I told them, I said, that's great, we're going to get into all of this, I'm going to collect all of this information, but before we do that, let me just briefly explain sort of what our practice is designed to do and what we're going to try to help you do. And then let's talk a little bit more about what you're trying to accomplish. And we're going to use this information to build that plan out, but it's not as simple as just, okay, here's this, go do this. And it's not so binary. It's not so black and white. It's more about what are we really trying to accomplish here? Because if you've worked and saved money for 30 or 40 years and you're planning for a 20, 30 plus year retirement, it's not as simple as just, plugging numbers into a piece of paper.
Right. No, that's really good. And I'm sure they're great people. But the problem is...
that was their expectation.
Exactly. So they're probably used to other advisors doing that.
Exactly.
So big red flag is if you're meeting with an advisor or your current advisor talks about your investments before they talk about your plan, that's something that I would definitely be wary of. Or maybe you got assigned a new advisor and they just started going into your investments and your performance and maybe picking apart maybe your current investments or your old advisor's investments or whatever without really taking the time to get to know you and really to figure out what is this money looking to accomplish. That's a huge red flag to me. So again, you want to work with somebody that's, not to use when I go to the eye doctor, the doctor doesn't look in my eyes and say, well, this is wrong, this is wrong. No, they do all these tests first. And so the financial plan is basically a way for us to check your eyes before we say, hey, you need glasses or you need contacts or, we're going to look at doing a surgery or whatever that may be. The investments are the actual function that's going to help your goals happen. But first, we got to figure out what your goals are.
Yep. The financial plan should lead the investment strategy, not the
other way around. Very good. No, that's a good one.
Yep.
All right. So the title of our show today is understanding mutual funds, and I wanted to go into a little bit deeper dive as to why we don't use mutual funds for our clients. Why don't you first kind of loosely define what a mutual fund is?
A mutual fund is a product where investors have money pooled together. Typically, that money would be managed by a professional money manager at a big mutual fund. Yeah, I know, a big mutual fund company. And the idea is, people pool their money together. There might be thousands of people that own shares of the mutual fund, and the manager takes all of the money that's in there and buys and sells and makes investment decisions. And the shareholders' return is based upon what they do.
Right. So there's tons of them. I think there's over 10,000 mutual funds. And I want to be very clear is that Corey and I don't think that mutual funds are bad. We just don't agree with using them for our clients because of the fee structure and the lack of control. So again, a mutual fund on its own isn't a bad thing. So if you're a do-it-yourselfer or you're investing in your 401k and all that you have available to you are mutual funds, it's okay to do that. And it's pretty easy to pick them out. You basically we typically used to look at a 5-year track record. And I was brought up in the industry to use mutual funds and to use products because that's the way a lot of advisors still invest clients' capital today.
Why? Why do you think that was the way that...
Why? Because I think incompetence. I think a lot of advisors, the problem with our industry is that there's not a large barrier to entry. And so almost anybody can become a financial advisor or a financial professional. And so if you don't have a background or you haven't taken the time to educate yourself, it makes sense for you to use products, frankly. If you have an advisor that used to, do something else before this, or, maybe they have a degree, or maybe they got their licenses and that's all they do, that doesn't make them magically qualified to invest money.
Good point.
That's why you and I went to Wharton. We went to, an Ivy League school and took a course on managing money.
Right.
And then we took it the next step and we hired an analyst whose full-time job is analyzing money, and he's in the process of getting his chartered financial analyst designation. I think that's why a lot of advisors still use mutual funds. And again, we don't think mutual funds on their own are bad. The issue we have are the fee structures. And so like Corey defined it, so if you're not a client of ours and you want to know if you own mutual funds, because a lot of people might not even know if they own them or not, typically they're basically you can figure out if you own one because their symbol is typically 5 letters. So it's 5 letters long, and it'll be, XYZ investment company, or, there's lots of different names out there. American Funds is a big mutual fund company.
Sure.
So it might say American Funds, or we've got a great one, American Century, here in Kansas City. Waddell & Reed has mutual funds. I mean, there's tons of them out there. And like I said, by themselves, they're not such a bad deal. What you have to be very careful of is understanding what the internal fee structure is, because not all mutual funds are created equally. Some of them may charge, 0.25%. Some may charge 2%. And you really don't know that unless you read something called a prospectus. And a prospectus is basically a legal document outlining what all of those internal fees are. Okay? So that's step number one. It's like, okay, I don't work with Jake and Corey. I don't know if I'm in mutual funds. Let me see what this is. And it's easy to just pull up, or if you're looking at your 401k, more than likely they're going to be mutual funds. You want to click the hyperlink and try to find a prospectus and look what those internal fees are. So that's number one. Go ahead. Do you want to add something?
Well, I was just also going to say, if you do find that you are invested in mutual funds and, if you have an interest, Morningstar is usually a tool that a lot of people use. You could type in the ticker symbol.
Or Google Morningstar first off. So it's basically a website. And what they do is they rank mutual funds.
Exactly.
Basically. It's a third party that will categorize mutual funds, and they typically give them a star ranking. Now, I don't really know what those stars mean, but they'll typically give it a 5-star or 2 stars, and it's probably based on performance. But yeah, so you go to Morningstar, probably Morningstar.com or Google Morningstar, and then you can type in
the ticker symbol.
The ticker symbol, if you know what that is, that would be that 5-letter piece of information that's on your statement.
And it usually ends in an X.
Usually, yeah, not always,
but
usually, I think you're right. It usually ends in an X. Or you typically in Morningstar can just type in the full name. And
or that, if you have that.
In there. And then Morningstar typically will show you that fee also. So if you don't want to go find the prospectus, Morningstar might be able to report that fee for you. So again, so if you're a do-it-yourselfer, you say, okay, Jake, I don't want to use an advisor, but I'm not going to look at the stock market every day like you guys do. I'm just going to put my money in this mutual fund. I'm going to look back, at least maybe 5 years, make sure they have a good track record. I'm going to know what my internal fees are, so I know what they're charging me, and I'm going to go with it. That's not such a bad thing necessarily.
And at least then you're educated, and you know.
Exactly. We're really big on financial literacy, and that's a big deal. The problem we had with them, again, we were taught to use these, early in our careers. So the mutual fund is this product we put our clients in, and then since we don't get paid anything by the mutual fund, we were taught to charge a fee on top of the mutual fund fee. So now the client, let's say the mutual fund is charging around 1% annually to manage the money. Well, if the advisor is charging 1%, now the client is paying 2% a year for something one or the other could do. So in our opinion, a competent advisor could just manage the money straightforward, or you could just go direct to the mutual fund, but you don't need to have both parties to do one job. It's like paying somebody to mow your lawn twice, or anything twice. It's like having two eye doctors. Do you have two eye doctors?
I don't.
Right? Or it's like I could go on, right? But there's no need to have two layers of fees when they're basically just in the end getting one job done. So that's why, after years of doing it this way and our clients underperforming, we get tired of it. We got fed up with it. And then there's a lot of things on our end that we don't like. We don't like not having control. So they may be buying stocks that are not necessarily in our client's best interest.
And that happens.
It does happen, right? We don't like that our clients don't know what they own. It's just scary if we, meaning you and I and our team as fiduciaries, are going to be trusted to only act in our client's best interests. We don't feel confident outsourcing that investment management to somebody that doesn't know anything about our clients.
Right.
I don't like that.
Yeah, it's really just the lack of transparency, the lack of control, and the high costs.
Right, the fees. So, again, so the point of this segment of our show is that you just want to understand. That's the key part of it. You understand what you own. Again, they're not necessarily bad, but if you know, hey, I'm paying my advisor 1%, this mutual fund's charging me 1%, and you're okay with that, then there's nothing wrong with that. We happen to disagree with it. We think that's far too much to pay. And so we don't do that for our clients. But again, if you're comfortable and you understand it, then that's okay. So anyway, so that's, I don't know, do we leave anything out on mutual funds? So again, we don't use them for our clients. We buy stocks and bonds direct. We cut out the middleman, lowers the fee, gives us more control, more transparency. And, that's just, again, our methodology. We've had a lot of success with it. And we're happy, we're open to if someone wants to say, well, I have mutual funds. How about you show me how you guys are doing and what you're charging versus what I'm in now and what they're charging. And we're happy to run that side-by-side comparison.
Absolutely.
To give somebody a little bit more clarity on that. Did I leave anything out?
I don't think so.
So last week we talked about exchange-traded funds and how they may be very risky. This week we're talking about mutual funds and how, sure, there's also risk associated with mutual funds, but we don't like them because of fees, transparency, and control. All right, very good. So for our third topic today, our fun topic, I believe we wanted to go into anniversary gifts.
We did.
Right? And I wanted to talk about this because most of our clients, or not most, but the majority of our clients are retired or they're getting ready to retire. And I just had my 2-year wedding anniversary with Rachel. And our 2-year anniversary
Congrats,
thank you. And our 2-year gift theme, if you Google it, is cotton, which was really hard for me. Mm-hmm. Right. So for our 2-year wedding, the first year was paper.
Right.
So I got Rachel stationery, and she got me beat. Of course, she had a custom book made for me, which was amazing, and then a clock made out of paper with the lyrics of the song we danced to on our first dance.
It's pretty neat.
Yeah, she always wins.
That's pretty good.
So this year was cotton, and I didn't know what to do. And there's a modern one, which happens to be China, and Rachel's a huge fan of China. And we were actually shopping for furniture for our office, and we found this antique China tea coffee set. That was actually not too expensive.
Nice.
She was just going to buy it because it was a really good price and it was beautiful. And I lucked out and I said, do you want that for your anniversary? And so I didn't surprise her, but I got her that. And she got me this really cool pocket square with a funny saying that we share amongst each other on it, along with a golf towel with the letter F on it for Falcon. So
nice.
And she won again. But you looked up
next year.
You looked up. A lot of our clients are celebrating their 40th wedding anniversary, which is pretty awesome. So you're 29,
I am.
right? So Flash, you're getting married this year, so this would be when you're 69, what you'd be getting Cassie. And what is the theme?
It's a ruby.
A ruby. And I looked at you like, really,
I know.
Corey? Google that again.
I know. I looked at it, and it turns out when you talk about your traditional and modern, it's considered to be both.
So a ruby. So for all of our clients that are retired and getting ready to celebrate their 40th wedding anniversary, we want to first say congratulations. But also, why don't you throw out some gift ideas when you were thinking of buying somebody something with a ruby in it?
I mean, I saw something like if it was a ring or a bracelet. I mean, you naturally you're going to think about jewelry, right? I admittedly, maybe Rachel would be able to help us.
Yeah, maybe we need that.
But
Rachel up with that.
as far as creativity,
What about
goes,
Dorothy? Didn't she have ruby shoes?
I believe
The
so.
Wizard of Oz?
Yeah, that's a good. Yeah, she did.
So you could get shoes. What else is out there? Maybe a hat with the ruby in it? You're a Cardinals fan, aren't rubies red?
They are, but
So
a hat
maybe-
with a stone in it.
Yeah.
Okay, I guess that's one idea.
I don't know. I'm trying to be creative. Maybe a Cardinals thing with the Cardinals, and maybe Cassie can get you a Cardinals ring with ruby.
Or just a ring with a ruby, something like that.
You would wear a ring with the ruby?
40 years from now, maybe. But
Awesome.
anyway,
There you go.
The point.
I don't think I would, but hey.
Hey, you never know. I was thinking too, if a husband was shopping for his wife, even if there was some type of like a nice like a bag, like if it was like whether it's a larger
with
bag or like
ruby
a
on
purse
it?
with like a with
That's
a stone.
pretty cool.
Yeah, I don't know. Just an idea.
Yeah, so I know also that, have you written the blog yet on retirement parties?
No, I haven't.
So that'll be coming
It's
out
coming.
also, and then Corey's going to write another one. I've got you 2 assignments for you. Another one on anniversary gifts.
Yep.
And maybe some ideas or websites that you can go to on that. So Corey's building out, what do we called it, 100 retirement questions answered.
Exactly.
And so the idea is that we want to help clients and potential clients preparing for retirement or celebrating their 40th wedding anniversary with some good ideas.
Yep.
So again, our clients come to us for a variety of things, and we want to be part of their lives, and that's just something that we enjoy doing. Any other Ruby ideas?
Not off the top of my head.
Fair enough. Well, that's all the time that we have for today's show. Thank you, as always, for tuning in. Please mash that like button on YouTube and subscribe to our channel. It's Upticks, a financial planning and investment podcast. You can also find the podcast on Spotify and iTunes. You could find our team on various social media platforms. We're on Instagram, Twitter, LinkedIn, and Facebook. And you can find me personally on Twitter at Jake Falcon CRPC.
And you can find me at Corey Bittner KC.
Thanks again for tuning in, and we hope you all have a great week.